Target Corporation is one of the biggest retailers in the US. Target's co-founder, Douglas Dayton, envisioned the chain as providing high-quality merchandise at discount prices. There are so many chains like this today, but back in the 60s, Target was one of the pioneering companies in the field. This formula proved successful, and the retail giant has continued to grow for over 60 years now. As a dividend king, Target has now increased dividends for 54 consecutive years. On top of that, management has emphasized that dividend growth continues to be one of Target's highest priorities. In the first quarter of last year, Target raised dividends by 20%. This year, they've raised them by a much smaller amount, but this still shows that Target is committed to maintaining its dividend growth streak. This is obviously great news for dividend growth investors, but is Target really worth buying right now? Let's take a look at their latest earnings, which Target released just last week. It's safe to say that the results were mixed. The adjusted EPS beat expectations by $0.38, resulting in earnings surprise of 26.7%. This is a very good earnings beat indeed, and great news. The only problem is that revenue missed by about 2%, coming in at $24.77 billion. The miss may have been okay on its own, but this also meant the Target sales were down 4.9% as compared to the same period last year. Comparable sales were down 5.4%, a few percent lower than the 1.7% consensus. What is worse is that management lowered both sales and profit guidance for the rest of the year. They expect a pretty big decline too. New adjusted EPS expectations are $7 to $8, down from $7.75 to $8.75. Revenue is also expected to be down mid-single digit, so somewhere around 4 to 6%. On the bright side, margins have improved. Gross margins are up to 27% from 21.5% a year ago. Operating margin was 4.8% versus 1.2% a year ago. Plus, inventory is down 17% as compared to a year ago, which means less money is tied up and sitting around in Target's warehouses. Retail is all about efficiency, so this is a step in the right direction for Target. Unfortunately, Target did not repurchase any stock during Q2. That's a bit of a shame honestly, a missed opportunity. Their stock price has been down, the lowest point since late 2020. Now is the perfect time to repurchase shares. I hope they pick it up during this quarter, because they still have $9.7 billion remaining for share repurchases. I can understand why they didn't. They know they're gonna have a bad year ahead, like we've seen with the guidance, so they want to tighten spending. Repurchasing shares now though will maximize the value they deliver to shareholders, so it will be good if they act on it. The last thing that I wanted to mention was that Target remodeled 51 out of the 175 stores and opened their 10th sortation center in Miami as part of their strategy to improve their digital fulfillment. Target also opened 11 out of about 20 new stores planned in 2023. Over the last 10 years, Target have been opening about 20 to 30 new stores per year, so this is business as usual for them. So, that's Target's latest earnings in a nutshell. What am I thinking right now? Well, the results were mixed and it's not great that we're seeing a slowdown in sales. On the flip side, it's good to see that margins are improving again. They were down from the historically normal levels for Target, but it looks like they're coming back up. Overall, I feel like this is a good time to start opening a position in Target. The stock is down more than 50% since its peak of $266 in November 2021. Meanwhile, it is only about $30 away from its March 2020 lows of $96. The risk-reward ratio here looks good from a technical perspective. However, Target's momentum is really bad, way worse than the rest of the sector. Since last May, Target's stock price has been struggling, and it looks like that will continue until the management gives us some good news. Target stock is definitely on a negative trend, with its current stock price below the 10-day, 50-day, 100 and 200-day simple moving averages. That's why I think this is a bet which will pan out over a few years. I doubt we will see Target's stock price jumping up anytime soon. On the bright side, this does give us time to build up a position in the company. Target is a great choice for dividend investors in my opinion, and that's also why I'm considering buying the stock. Just look at the dividend stats. The yield is 3.52%, which is above the sector median and also above Target's 5-year average. Like I said at the start of the video, Target's dividend has been growing for 54 years now, making the stock one of the 47 American dividend kings. Plus, the management is obviously keen on keeping their dividend streak going, so I think the dividend is pretty safe. The payout ratio is a bit high right now, at close to 60%, but once profit margins normalize, that should drop down to 50% or so. Target's dividend has compounded over 11% annually over the last 3, 5, and 10 years, way higher than the rest of the industry. Analysts are also expecting a 10.2% increase in dividend next year, which makes sense given what the management has said. It is a bit uncertain whether they will keep this pace up after the challenging year that they are having now. I remain optimistic though. After all, Target are good at putting their capital to use. The return on equity is close to 30%, a bit below their 5-year average, but way higher than the rest of the industry. Same goes for their return on assets. Another thing I like about Target is how many shares they repurchase. They've reduced the number of outstanding shares by 27% over the last 9 years. We have also seen that they've got close to $10 billion authorized for share repurchases, which currently equals 1/6, about 17% of their total market cap. Share repurchases make it easier for the company to increase dividends, so that is again good news for dividend investors. Obviously, it would be really good to see management actually using this allowance to buy back shares. Currently, they are not, but I would like them to. I also want to see them managing their debt a bit better. They have taken on an extra few billions over the last 2 years, and this will be problematic going forward if interest rates remain at this level. Obviously, this isn't a massive problem right now, but it could easily turn into one. So, overall, I think Target's stock price right now offers a good entry point for long-term dividend investors. If you don't care about the dividend, then you probably don't want to open a position in Target just yet. However, it's good to keep an eye on the company. Once Target stock stabilizes and starts reversing, this could become a very profitable opportunity. That's what I think. What do you think? Is Target a buy, sell, or hold? Let me know in the comments below, and please leave a like if you enjoyed this video. Thanks for watching, and I'll see you again in the next one.